In this session, let's try to understand the Greek letters or Greeks in short, which are different kinds of mechanisms, different kinds of tools in assessing the sensitivity of the derivative price, right? Sensitivity of the derivative price when some of the elements of the underlying is changing. Probably when the underlying stock price changes, or if the interest rate changes, if the volatility changes, or if the dividend rates change, or it could be if time to maturity changes. Now, with any of these different things changing, what is the kind of an impact that has on the derivative securities? So these are the different kinds of measures associated with the changes in any of these elements on the prices of the derivative. So why we really need to understand them, what is the benefit we get out of them, is something which we will take up as a part of this session. So we will try to talk about the basic conceptual aspects, why the Greeks are required. Conceptually, we will talk about a naked position versus a covered position, what happens in each of them, what is the way of mitigating the risk using a stop loss strategy, and what is the kind of effectiveness or ineffectiveness associated with this strategy. Then move on to the usage of the Greeks. What do I mean by delta hedging? How can I do a proper delta hedging of my portfolio? What are the loopholes after doing the delta hedging? Then a few more Greeks like theta, gamma, we'll try to understand. Now what connects delta, theta, gamma? Then a few more Greeks like vega and rho. So these are the 5 major Greeks we are going to look at here. And after that we will get into the process of understanding the realities of hedging, performing a scenario analysis. What does that mean? Then if at all this we will try to understand using a stock which is non-dividend paying. Right? We'll compute different kinds of Greeks for the stocks which are non-dividend paying. Now if I have to extend that to the stocks which are dividend paying or to the currencies, what is the kind of an extension that I can look at? And finally we will discuss about the concept of portfolio insurance. So these are the different topics that we are taking up in this session. So the first thing, the intention for any derivatives trader is manage the risk. Let's say if he has sold some options, he might have got a premium, right? But after that, he is exposed to more and more risk. If the buyer of the option wants to exercise it, there is no other option. This person has to adhere to the contract. So the buyer will exercise only when there is a profit to him, which means there is a possibility of loss to the seller of the position. So how is he mitigating the risk in that particular position? So the computation of the Greeks is always to target the different dimensions of the risk. Right? If the stock price changes, how do I address? If the risk-free rate changes, how do I address? If the volatility of the underlying asset changes, how do I address? Right? So all these things are important in terms of mitigating the risk of the portfolio. And so the aim of the trader at any point is to handle all these Greeks. We'll talk about how we compute these Greeks, but handle all the Greeks so that the risks, all of them are coming under the acceptable limits. So that is what we are going to look at. Before we get into that, we need to understand the two different positions that we can take with respect to an option. For that, let me take an example of someone who has sold a call option. So let's say X has sold a call option and Y has bought the call. Now look at this. If Y is going to exercise this option, means he will buy it, he will buy the underlying asset at a future price P1, at a price P1 which is already fixed. And obviously he will exercise this option when the market price P2 is greater than P1. Now it would be mandatory for X to sell that asset at P1. Now imagine that X does not have that asset. Then he may have to buy it in the market, right? He may have to buy that asset in the market probably at P2, but sell it to the Y at P1. So he is incurring a loss. Now this is where we are talking about the two positions. One, a naked, means at this moment do nothing. You just sell a call and leave it. So in that, what is happening? If Y is exercising, then probably X may have to buy it at P2. So there is a expense of P2 that is incurred, but he is getting P1. So overall there is a loss that he is incurring. But if Y is expiring the option, he is not exercising the option, then obviously there is nothing for him to do. So there is no loss or no gain. So in some cases he just received the premium and he doesn't need to pay anything, especially if Y is not exercising the option. Whereas in the other case, there is a loss because he has to buy something from the market at a higher price and then sell it. So that is what we are calling as a naked position. Right now, do nothing. You just sell the call option and sit like that. So it works well when the option is not exercised. But if the call option is exercised, I may have to purchase the shares from the market at a higher price and sell it to the call buyer. So that's the disadvantage that associated with the naked position. But on the other side, let's say I go with a covered position. When I say covered position, okay, because I have sold a call, there might be a possibility that Y may exercise this call. So I may have to sell him the call. So it's always better, let me buy the underlying share, buy the underlying asset along with selling the call option. So in case this person is exercising, obviously I can very well deliver the asset because I already have it. So when Y is exercising the call, this is a good strategy because I have the asset to deliver. But if Y is expiring, is not exercising the call, when will Y not exercise the call? Typically when the market price is below P1, below the strike price, then he will expire it. And if he is expiring it, me holding an asset which value is much lesser, right? The asset which I have bought, the value has gone down. So I'm losing out on that, right? So that is where a fully covered position is also not doing any kind of a mitigation for my risk. So which means neither a naked position nor a covered position is providing a good hedge for me. Once I have sold a call option, I cannot just sit idle waiting for the person to exercise. Only when the person exercises, I'll have a loss there. If I'm going with a covered position, I'm buying the underlying asset today. Only when the person is exercising, then I'll have a benefit. But if the person is not exercising, there is a big loss that is coming up in that position because the value of my underlying is going down in that kind of a position. So for that we are talking of another position or another strategy called stop loss strategy. Again with the same example, if I have written a call option, what it says is, let's be dynamic. Don't be fully naked. Don't be fully covered. Look at the movement of the stock price. Okay, this is the strike price. If the stock price moves above this, just above K, if the stock price moves just above K, it means the buyer has the chance to exercise the option. So it's better that you have the asset. Means you go and buy 1 unit of the asset. And the moment the stock price falls below K, the chances that the buyer will exercise the option are going down. The higher is the chance that he will expire the option. So if he is expiring it, there is no point in you having the option. So basically sell it off. So what this procedure says is, immediately after the price crosses the strike price and above, go and buy the underlying. The moment you see that the stock price is going below the strike price, then you just keep selling that asset. So which means it's a combination of naked and covered position. If the stock price is less than the strike price, go naked. If the stock price is more than the strike price, keep covered. Right? So there is a owning of the stock. You are buying the stock and owning it if the option is closing in the money, where the stock price is greater than the strike price. We say that the option is in the money. So we are owning the stock when the option is in the money. We are selling off the stock and not owning it when the option is going out of money. So that way it is much better itself. But what is the disadvantage here? How many times I buy and sell? Right? In some cases, probably if I am going for an out of the money option, if the strike price never touches, no issues. But if it is more and more like a fluctuating kind of stuff, and this is the strike price, every time buying, selling, how much of transaction cost is incurred for me? Right? Strike price, if it is crossed so many times up and down, the transaction cost becomes so high, the procedure becomes more and more expensive. Probably I can do the simulation, the Monte Carlo simulation, trying to understand how many times the price might go up, go down, to basically assess the effectiveness of this strategy. And because of this reason, we may not find even this stop loss strategy to be a much better mechanism for hedging that kind of a risk. Though ideally it looks like the moment the price is going up, I am owning the stock. The moment it is going down, I'm getting rid of it. Though theoretically it looks much viable, the moment I try to put it into a practical situation, because of the transaction costs that are built into it, the strategy becomes less viable. So any kind of a hedging scheme, if I am trying to bring in, the performance measure should be close to zero, which means it should more or less try to mitigate the risk in almost all the kinds of scenarios, not just when people don't exercise the option, or not just when people exercise the option. In almost every case, the payoff, the protection should be offered by the strategy that I am following. Now this is where the importance of delta hedging came into picture, or hedging the strategy using the Greeks. So just before this before this thinking of Greeks, initially it started that I'll go either naked or covered. After that, there is an improvement on the strategy saying, no, naked and covered exclusively may not do any job. So let's go with a stop loss strategy where in some cases I go naked, in some cases I go covered. But even that is not proving fruitful. That is where the next methodology with respect to hedging came up, which is what we are calling as delta hedging. So when we are talking about the sophisticated hedging procedures, we are calculating the Greeks such as delta, gamma, vega and using them for the purpose of hedging. And if I have to define delta, it's the rate of change of the option price, but what rate the option price is changing when the underlying asset is changing. So if the underlying asset has increased by $1, by how much dollars is the price of a call option has increased? Let's say it is 0.6. Then we say the delta of this call option is 0.6. So it's the slope of the curve that relates the option price to the underlying asset price. If I am saying option price to the underlying asset price, the slope of the curve. So the moment you are seeing that a change in the call option to a change in the stock price, that is what we are calling as delta. So suppose the stock price is $100, option price is 10. So imagine an investor who has sold the call option to buy 2000 shares of a stock, which is 20 contracts, which means around 100 contracts, 100 shares per each contract. Now you can talk about the investor's position. If the delta is 0.6, I can talk about that the investor's position could be hedged by buying 1200 shares. Now look at it. If the delta is 0.6, means whenever the stock price increases by $1, the option price increases by $0.6. Similarly, if the stock price falls by $1, the option price will fall by $0.6. Now let's say I have sold 2000 call. 2000 call option, right? So because I have sold 2000 call option, the delta of it is 0.6 times. So 1200 is the delta associated with my selling of the calls. Now I'm buying 1200 shares. The delta of a share is 1. Means basically, let's assume like this. If the call option price has fallen by $0.6, I can say that the stock price will fall by $1. Correct? So because I have sold the call options, let's think of the call option price has gone up by $0.6. If the call option price has gone up by $0.6, as a seller, I'm losing 0.6 because I have sold it at some amount, and now the price has gone up. I could have sold it at a higher amount. So my loss is $0.6 on 1, and like that I have sold 2000 calls. So my loss is $1,200. Now how can I compensate that? If I had bought 1200 shares, each share has resulted in $1 increase. So overall my gain would have been $1,200. Both would have negated or offsetted each other. So the delta will help me in terms of deciding how many underlying should I really buy or sell to make sure that the delta of the overall portfolio is 0, or to make sure that my loss in the overall position is close to 0. The gain or loss on the stock position would tend to offset the loss or gain on the option position. And a simple way to do the calculation, delta of one share of a stock is always 1. So when I am making my portfolio delta neutral, it means that I am creating a portfolio with a net delta of 0. Right? For a selling position, the delta is always negative to that, opposite to that of a buying position. So if I am buying, if the delta is positive, selling of the same thing will result in a delta of negative, and vice versa as well. And one thing we have to understand, delta is not a constant stuff. As we keep changing the price of the option, the delta also keeps changing, which means I cannot do this exercise once and sit idle. I can't say I'll buy 1200 shares because I have sold 2000 call options and I can't sit idle for the remaining period. The delta will remain constant only for a very short period of time, which also means at every point in time I am trying to calculate the delta of the option and balance the portfolio accordingly. Either I increase the number of shares, I buy additional number of shares, or sell some of the existing shares. So dynamically I am trying to either increase or decrease my position to make sure that the overall portfolio is delta neutral. This is where we talk about the dynamic hedging, where on a regular basis I am trying to either buy the shares, buy the underlying, or sell the underlying depending on the option delta that is arriving at. At the end, my intention is to make the portfolio delta neutral. So when I am doing the changing of the portfolio composition to make sure that the overall portfolio is becoming delta neutral on a dynamic regular basis, we call that process as delta hedging. Sorry, dynamic delta hedging. But if I am doing it once and just sitting back, like hedge and forget, initially set up, after that I am not changing the composition of the portfolio at all. In that case, we are calling static hedging. And what is essential for us to understand is it's the dynamic hedging that really helps in bringing a better change in the value of the portfolio. So options can always be valued. If at all I am looking at trying to compare it with the Black-Scholes model, or probably the binomial tree if you are trying to recollect that, we have set up a delta neutral position, especially the arbitrage free, or probably when we are called as no arbitrage kind of evaluation. Under the scenario of no arbitrage and the risk-free world, where we said whether the stock price goes up or goes down, the value of the portfolio should be the same. And we said we buy the delta number of shares and go short on one call option. Now this delta number of shares is nothing but the Greeks that we are getting. And that is what has led to the computation of our option pricing as well. So that is what we are trying to say. The valuation of the option, whatever we have done, whether it is through Black-Scholes or binomial trees, we have set a delta neutral position. And if a delta neutral position is being set, we are expecting that the return on that delta neutral position should be a risk-free interest rate, because there is no uncertainty on the maturity date, on uncertainty of the price on the maturity date. And just to compute the stuff, if I am using the Black-Scholes formula, the delta of a call option on the European call option on the stock which does not pay any dividend, we are simply saying that N D1. D1 we have earlier computed, right? Log S by X plus R plus sigma squared by 2 times T divided by sigma root T. So, and the cumulative normal distributed value of N of D1 is what is giving me the price of the call option, and ND1 minus 1, or which is minus of ND1. right, or n of minus d1, which is minus of n of minus d1, which results in n d1 minus 1 will result in delta of a put option. So probably if you are looking at delta of call minus delta of put should sum up to 1. That's one more relationship you can very well look at. So for a short position, the delta is always the opposite to that of a long. And what we also see is delta for a call is always positive. Delta for a put is always negative, because as the stock price increases, the call option price increases, which means the delta should be positive. As the stock price increases, the put option price decreases, which means the delta for a put should be negative. So long position in a put option should be hedged with a long position in the underlying, because if at all, because the for a put delta is negative, means I have to take a long position only to do the hedging, whereas for a call the delta is positive, so I have to do a short position to make the portfolio delta neutral. So some essential things that we really need to understand. And look at a few important relationships here. As the stock price is increasing for a call, the delta is also increasing from 0. So if the stock price is very, very small, the delta is very much closer to 0. But if the stock price is very, very high compared to the strike price, the delta is very much close to 1. But if the stock price is closer to the strike price, which is like at the money kind of an option, we see that the delta will be somewhere around 0.5. For at the money options, I can say that the delta of the call option is around 0.5. Similarly, look at for a put. If the complete out of money, if it is a complete stock price is completely close to 0, the delta is minus 1. And if the stock price is increasing, which is where the option is becoming, right, which is where the option is becoming out of money. Here it is in the money, so the delta is close to minus 1. Here the option is becoming more and more out of money, the delta is becoming very much close to 0. And probably at the money, the option is the value of the option or the delta of the option is becoming close to minus 0.5. Because you will find that ND1 minus 1 is what would be the delta of the put. You can find the graph accordingly. That's one aspect. Now look at another dimension with respect to in the money, at the money, out of money option. As the time to expiration is increasing, you see for the call option, for the in the money, the delta is falling, but it's not a big fall, just a moderate fall. Whereas in case of out of money, right now the chances of exercising the option are much minimal. So that's the reason the delta is much smaller. But if there is a lot of time to expire, there is a chance that the option can come in the money. So that's the reason the higher is the time to maturity, we see that the price of the call option is increasing, both for out of money as well as for at the money option. Right, so both of them are increasing, whereas in case of in the money, it is falling because right now it's in the money. Now as the time to maturity increases, there is a good chance that the stock price will fall. So if it is already in the money, probably the delta is much higher, but as we move with too much of time to expiration, there is a chance that the delta can keep falling. So this is some important relationship that we really need to be comfortable with respect to the delta hedging. So talking about some dynamic aspects, stock price falls, delta will decline, because delta for a call option is positive. So if the stock price is falling, we are seeing even here, if the stock price is falling, which is a much lesser stock price here, the delta is much lesser. So the new delta of the portfolio even more decline. And if the delta is declining, the number of shares which you have initially purchased, that money are not required to maintain a delta neutral position. So we are selling. So when we are selling the shares, again some amount of cash is getting realized. And what we are also seeing is the delta will be coming closer to 1 here as the stock price is increasing drastically. So if the option is closing in the money, it is coming close to 1. If the option is closing out of money, it is becoming close to 0. The same thing goes with the put. If the option is closing in the money, you will find for a put close to -1. If it is closing out of money, it's going closer to 0. And if the rebalancing is taking place more frequently, okay, the cost of hedging is getting reduced because I am doing sometimes getting cash, sometimes paying. So there is some kind of a balancing out that is happening. It's a much better improvement over the stop loss strategy where I am buying the underlying when it is in the money, selling it when it is out of the money, because the performance of a delta hedging strategy, it becomes better and better once we are monitoring it on a regular basis. And the major aim of a delta hedging, or the major aim that is accomplished by delta hedging, is the value of the position is coming closer and closer to unchanged to a large extent. Whatever is the change in delta that is coming, the position is getting adjusted immediately. So that is one advantage that is coming, whereas when it is with respect to stop loss, only when it has moved above K or below K, we are taking an action, but somewhere it is moving away from K either in the upward or downward, we are not taking any kind of an action, which means we are not able to minimize the fluctuation that is associated with the position. So the constancy in the position is not getting maintained in a stop loss strategy, whereas it is very much implemented when it comes to a delta hedging strategy. So that's the reason we find delta hedging to be much more beneficial and useful compared to a stop loss based hedging strategy, right? Now, if I have to extend my understanding from the delta of a single option to a delta of portfolio of options, it's a straightforward stuff, right? Whether it is for a single or for a portfolio, we are simply using the mechanism to be the same. It's a weighted average of the individual deltas. For the individual options, whatever the deltas are computed, I simply do a weighted average of those individual deltas to compute the delta of the portfolio. So it is primarily used to calculate the position in the underlying asset, finally to make the portfolio's delta 0. At the end, for different options, what I'll do, I'll find Wi delta I. And finally, let's say after doing all this, the delta comes to -200, which means all I have to do is take a position in 200 shares of that 200 shares of worth of that particular portfolio to make the overall portfolio delta to be 0 and make it delta neutral. Now, when we look at from the perspective of delta, looking at from the transaction cost dimension, the derivative traders in reality, they balance their positions at least once in a day. So they are trying to maintain their portfolio very close to a 0 delta kind of a scenario. But remember the practicality, if there are smaller number of options, the bid offer spread is very high, means the transaction costs are much higher. There is an economies of scale that we talk about. Means the higher is the number of options, the lesser would be my transaction costs and vice versa. So that is one point that needs to be considered, especially if for a small company which is having fewer number of options, Probably the transaction cost would prevent them from doing a dynamic delta hedging on a regular basis. One trade in the underlying asset is necessary to zero out the delta for the whole portfolio. That is one slight advantage when we talk about the delta of a portfolio. Next, we will move on to theta, another Greek, which plays an important role in the valuation of in the management of risk. So just like we talked about the delta being the change in the price of the call option to a change in the underlying asset, theta talks about the change in the value of the call option or a portfolio of call options, portfolio of options with respect to the passage of time. Right, with respect to the passage of time, not with respect to the change in the underlying. Now that is where some small difference come. The change in the underlying is very much uncertain. You don't know which direction it goes. But the change in time to maturity is more or less certain. It is guaranteedly going to happen. So that's where we may have to have a different procedure for both of them. Here there is a lot of uncertainty, here there is a certainty. Right? But whatever it is, the theta of a call option comes with this kind of a formula. Minus S naught, the stock price, N dash D1, which is the probability density function associated with D1, which comes out with E1 by root 2 pi e to the power of minus half D1 squared. So this is the value that comes associated with N dash D1 sigma and divided by 2 root T minus RKE minus RT, which is nothing but the price of the call option. Whatever we had, we take the derivative of that with respect to the time to maturity T. And that is what will give us this particular formula. The derivation of it is not in the scope here. But if I am trying to recollect, just look at this formula to compute the theta. I can use this formula. Rest all, if you look at in the price of the call option, you have K e power minus RT and D2. I take the derivative of this. That's the reason I get minus R here. Similarly, we talk about S naught and D1. So in S naught, you don't have the T, but in D1 you have the T. So that's where you are doing a D dash of N dash of D1 and you are taking the derivative of the D1 with respect to T, which will end up with something like this. So primarily look at it from that perspective. For a put option, it goes exactly the negative. Minus S naught N dash D1 sigma by 2 root T plus. So here this part would be a plus instead of minus. RKE power minus RT N of minus D2, which is nothing but 1 minus ND2. So theta of a put exceeds the theta of a corresponding call by this much amount. You could clearly see here. That is one way. If I remember for the call, probably if I am subtracting theta of put minus theta of call minus S naught. So this number minus of this. So when I am doing minus of this, this is becoming plus. So this part is getting cancelled off. Right. So here I am left with RKE power minus RT. Right. RKE power minus RT ND2. Right, when I am doing a minus of this, it is coming RKE power minus RT ND2 plus RKE power minus RT. N of minus D2 is nothing but 1 minus ND2. So you could very clearly see that the difference is nothing but RKE power minus RT. So the theta of a put option exceeds the theta of the corresponding call by RKE per minus RT. So that's one way to remember the thetas for both. And in general, the theta is measured in years. So we can actually look at one example wherein we can compute all the Greeks for that. So let's take a simple example where the spot price S naught is around 40. The strike price X is also around 40. And we'll talk about the time to maturity being 3 months. And the sigma, which is volatility, let's take it around 25% per year. And the risk-free rate of return, let's say per year, let me take it at 8%. So with these 5, I can first find out D1 using the Black-Scholes, wherein I am talking about equal to log S by X plus K e power or X, S by X plus R plus sigma squared by 2 times T divided by sigma root T. Right, so this forms my D1 and D2 comes out as D1 minus sigma square root of T. So this works out to be my D1 and D2. I can find out the ND1, which is using the norms dist function. ND1 is computed as 58.8%. The same thing comes out with ND2 using the norms dist. I take this D2 and cumulative, so which says 0.53. From here comes the price of my call option, which is nothing but S naught times ND1 minus the present value of X, X by e power RT times ND2. So the price of the call option comes out to be around 2.39. Fair enough. Now let's try to compute the deltas or all the Greeks. When I say delta here, we have got the formula for delta for a call option as ND1. So ND1 we have already computed. So at this point the delta is around 0.58. Fair enough. Now for the same, if I have to look at the theta, right? So here let's talk about for a call as well as for a put. For a put we have already said delta is nothing but ND1 minus 1, which is minus 0.41, because delta of a call minus delta of put should be equal to 1. Similarly, if I am talking of theta, okay, minus S naught. Now first of all I require to find out N dash D1, right? Rest all we do have. So let me say I have to compute even N dash D1. N dash D1 is what I am trying to compute, which works out to 1 by square root of 2 pi, 1 by square root of 2 pi e to the power of minus half D1 square. 1 by square root of 2 pi e to the power of minus half D1 square. So this becomes N dash D1. So from here I can find out the theta for the call option, which is minus S naught times N dash D1 times sigma divided by 2 into square root of T. 2 into square root of T, that's the first term. Okay, then minus R K E power minus RT. So this is R K, which is the strike price, E power minus RT and D2. So this is what is working out to be my theta. So in this case, theta is coming out to minus 5.58. And that is the theta for the call. So for the theta for the put, I can just increment the theta for call, whatever I have got, by RKE per minus RT. RKE power minus RT. So the theta for the put option in this case is coming out to minus 2.244. What you could see is theta is coming out to be negative both for call as well as for the put. This is the one that is measured in years. And what you could see here, okay, let's see the pattern now. If the stock price, let's try to understand here with respect to the stock price. If the stock price is lesser, my theta should be very much close to 0. Let's try to observe it. If the stock price is 20, my theta is very close to 0 for the call. The theta is very close to 0. That is what is coming out. Make my stock price 25. Theta is still close to 0. Make theta close to 30. Theta is improving. Minus 0.38. Right? Theta is improving. So as long as we are increasing this, the theta is keeping on. Now once I have got it closer and closer to in the money or slightly closer to the strike price, the theta is increasing. So with a negative value. So this is what we could see, the theta being increased. And the theta will have the highest negative value at the strike price. So when I am putting the stock price as the strike, theta is minus 5.58. That is the highest. Now make it again 45, again it started falling. So this is what is the pattern that we are observing. And at a very high strike price, the theta would be a very gradual change. If I put a stock price of this, it's still not falling below this. Right, 120, still at minus 3.13, it's not going below that. So that is where you could see that it's not coming and touching here, it's somewhere stopping here itself, right? So this is very clearly understood for a call option. And we have also seen with the time to maturity, at the money option will drastically vary. If the time to maturity, look at it like this. Right now the time to maturity is 0.25 and this is at the money option. Theta is minus 5.58. Let me make it 1 year to maturity. The theta is coming down. Let me make it 2 years to maturity. The theta is even further coming down. But let me make it just a few days to maturity. The theta is going up like anything. So if the time to maturity is increasing, the theta is coming down like this. As the time to maturity is increasing, the theta is coming down for all kinds of options. But until certain time, you see that for out of money and in the money options, the theta will increase and after that it starts falling drastically. So that's the kind of a pattern you observe for theta with respect to the call option. And once we get the value for the call, we can adjust it for put accordingly. It's usually negative for an option. That is what we have seen here. For all the options, generally we are seeing the theta as a negative value itself. Because as the time is passing on, the option tends to become less and it's coming closer and closer to maturity. The option is becoming less and less valuable. So when the stock price is very low, the theta is close to 0. We have already looked at. At the money call, the theta is large and negative. As the stock price is becoming larger and larger, this is where the theta is narrowing down, which is nothing but minus RKE per minus RT. That is where the theta is finally lending to. And so for the put there, because the put will be higher by RKE per minus RT, the put will tend to 0 at larger stock price. For a call, the theta would be closing out at minus RKE per minus RT. And one more important point we need to understand, there is a lot of uncertainty with the future stock price, but there is no uncertainty with the passage of time. So from a hedging perspective, it need not be a big thing for me to hedge against the theta. It's very much essential for me to hedge against the movement of the stock price because I don't know how it is going to move. So that is where delta becomes very essential as a part of the hedging strategy, but theta may not be to that extent because we know that the time will keep on passing. So there is no uncertainty with respect to the time. So generally it doesn't make too much of a sense to do any kind of a hedging against the passage of time, though we can think of doing that. But in comparison, probably the hedging with respect to delta is much more essential compared to the hedging with respect to the passage of time, which is theta based hedging. Then the third thing which is very essential for us to understand is the gamma. See, in the earlier slides, we have said that the delta is not constant. So delta keeps changing. So the delta is constant only for some period, only for a small period of time, or only for a small change in the underlying asset. So after a certain point, we see that the delta could change. And I really want to know what is that change in the portfolio's delta with the stock price change. So that's the reason we talk about gamma as dou delta by dou S, the rate of change of delta with respect to the change in the underlying price of the security. So it's as good as the second derivative of the price of the option with respect to the change in the underlying price. So it's the second partial derivative with respect to the price of the underlying. Now, when I say gamma is small, means delta is changing very slowly. Though the delta is changing, the change in the delta, the rate of change of delta is very, very small. So which means adjustments to keep the portfolio delta neutral, they can happen only once in a while because the delta is not changing so frequently, so drastically. I don't need to change my portfolio so much, so frequently. I don't need to alter it every now and then. So an infrequent adjustment of the portfolio is sufficient. But if the gamma is very high, whether it is negative or positive, what we simply say is for a long position, the gamma is always positive. For a call or a put, both of them. But for a short position, the gamma is always negative. So whenever we are seeing a high value, whether it is positive or negative, it means that the delta is going to change quite drastically. So delta is changing very drastically, means the portfolio rebalancing has to happen very much heavily. So risky to leave a delta neutral portfolio unchanged for a long period of time if my gamma tends to be a very high value. So it's a measure of the curvature of the relationship between the option price and the stock price. And what we generally see is this is the relationship. If the portfolio is delta neutral also, the small change in the value of the portfolio comes out as theta times delta t plus half gamma times delta s squared. So this much will definitely exist. So probably even if my portfolio is delta neutral, this relationship will still hold true. So it might so happen that if I have to minimize this, if I want to make the delta pi almost close to 0, it means I have to choose in such a way my gamma. I can very much estimate the gamma for a delta nu portfolio by going with theta delta t plus equal to minus of half gamma sigma delta s squared. So the once I have this, I can very well find out my gamma, which comes out as minus 2 theta delta t by delta s squared. So this comes out directly for the computation of the gamma as well. If at all I have to make my portfolio delta neutral and even the portfolio's value should not change at all, I can do the balancing through this kind of an exercise. So just few inputs regarding the gamma. Right here, let's talk about these situations. This is a situation where the gamma is slightly positive. This is a situation where the gamma is slightly negative. Okay, let's look at a few things. I change the stock price to in the money. First of all, let me compute the gamma. So I'll use gamma first of all using this formula n dash d1. Right, we'll compute the gamma like this: n dash d1 by s naught sigma square root of t. So if I'm looking at gamma here, it is n dash d1 divided by s naught sigma square root of t. S naught sigma square root of t. So gamma here is 0.07. Now let me come back. If my option is at the money, this is what is happening. Right? Make it more and more. Now let's say the delta S. Right? Now the change, if I make this, let's say 50, gamma is becoming much smaller. But if I make it 20, gamma is becoming much smaller. But if you look at 40, the gamma is slightly on the higher side. So slightly positive gamma and becoming more and more smaller and smaller. Whereas on the other case, right, we are talking about in some cases the gamma is going to be much higher, much lower. When the gamma is positive, theta tends to be negative, because we have already talked about that relationship between, we said that pi times, we said here delta phi is theta times delta t plus half gamma times delta s squared. Because of this relation, when gamma is positive, theta tends to be negative. So portfolio declines in value if there is no change in s. If s is not changing, still gamma is theta is negative. So the portfolio decreases in value. But if there is a large positive or negative change in s, because the gamma will be more and more positive, the theta will be negative, there will be an overall increase in the value of the portfolio because of that. So that is what we are saying. If s is not changing drastically, what we could see is the gamma will be, if s is not changing, the gamma is tending to be, the portfolio value is tending to be slightly negative for a long position. If the gamma is very much positive, or if s is changing drastically, the gamma is very high, which is what is changing in the value of the portfolio quite drastically. If at all I have to make my portfolio gamma neutral, so it is as good as make the position in the underlying asset having a gamma of 0. And if I am looking at underlying asset will always have a gamma of 0. So I cannot use the underlying asset for making my portfolio gamma neutral, because every underlying asset, the stock, it will have a gamma of 0 because delta is always 1. There is no change in delta. So which means the gamma will always be 0. So that underlying asset can never be used to make the portfolio gamma neutral. So which means I have to rely on the instruments which are having changing deltas. The instruments which are non-linear payoffs, especially option kind of instruments, are mandatorily required to make the portfolio gamma neutral. Non-linear payoff based portfolios or securities are required to make the portfolio gamma neutral. And what we do to make the portfolio gamma neutral, you take a position like this. Try understanding the gamma of the total portfolio. Find out the gamma of that instrument or the traded option which we are using to make the portfolio gamma neutral. Divide one by the other and take the opposite position. Right? But because I am using an option to make the portfolio gamma neutral, the option will have a delta as well. So because I am including this option as a part of my portfolio to make it gamma neutral, obviously that is going to change the delta of the portfolio because option itself is having some delta as well. So once I make the portfolio gamma neutral, then based on the new delta that got created because of the addition of that new option, I will take a position in the underlying asset to make the portfolio delta neutral, because underlying asset addition will not introduce any new gamma because the gamma of the asset is 0. So my portfolio will become both gamma neutral as well as delta neutral. But again, just like the way we understood the delta, portfolio is gamma neutral only for a short period of time, which means again a dynamic rebalancing is very much necessary. But the only advantage by making the portfolio both delta neutral as well as gamma neutral is delta neutral tries to protect against the small stock price changes. Whereas the gamma, if a portfolio is gamma neutral as well, it is protecting your portfolio against the large changes in the stock also. Which means when I am putting my portfolio to both, the rebalancing that is required is very, very rare. I can do the rebalancing not that heavily because my portfolio is being protected against both the small changes in the stock price as well as against the larger changes in the stock price. That's the advantage of making the portfolio both delta neutral as well as gamma neutral. And we have already talked about the formula for the computation of gamma. And just to understand this example, I'll take different stock prices. So right now the gamma is 0.007. Let me take the stock price as 30. Gamma has gone down. Let me take the stock price as 50. Gamma has gone down. So the gamma is highest at the money itself. So that's where when the stock price is close to the strike price, the gamma is the highest. And what we could see is as the time to maturity is increasing. Now let's look at the time to maturity. Instead of 0.25, I make it 1. The gamma is going down. Make it 2, the gamma is even more lesser. Make it 0.01, the gamma has shot up. So again, with the time to maturity, we see that the gamma value is coming down. So it's nothing but the change in the delta. Once the change in the delta is coming down, the gamma is also coming down. So for all the kinds of options, we are seeing as the time to maturity is increasing, the gamma value is actually falling. For at the money, it's a gradual fall. Whereas for in the money as well as out of the money, initially there is an increase in the value of the gamma, and after that there is a fall. And one thing, the gamma is the same both for a call option as well as for a put option. There is no difference in the gamma for call as well as a put. The only difference is for a long position it is positive, for a short position it is negative. At the money, Some of the important points to remember: at the money option, gamma increases as the time to maturity decreases, or gamma decreases as the time to maturity increases. Short life at the money options, at the money short life is having the highest gamma possible. Either I can talk of all these things with respect to the equation, or I can very well remember the graphical the graphical representations, and based on that try to assess where the gamma is high and where it is lower. Right? So these are some of the important aspects of gamma which we need to be comfortable with. Now let's try to understand the relationship between the delta, theta and the gamma. If you remember the Wiener process that we talked about, or if we remember the Ito's lemma and applied that Ito's lemma, the derivation of the Black-Scholes formula from that Ito's lemma, we have ended up with this kind of an expression: dou phi by dou t plus rs times dou phi by dou s plus half sigma squared s squared dou squared by phi by dou s squared equal to r pi, where phi is the value of the portfolio. Should be equal to the risk-free rate. That is the reason it came out to be r pi. Now if you see, this is nothing but theta. Now rs times, this is nothing but delta. Half sigma squared s squared, this is nothing but gamma, is equal to r pi. So if the portfolio is a delta neutral portfolio, delta will be 0. Which means I will be getting something like theta plus half sigma squared s squared gamma is equal to r pi. If theta is large and positive, gamma is negative, large and negative, and vice versa. Because this is just pi times whatever is the risk-free rate of return. So this is what is the kind of a relationship we can think of between delta, theta and gamma. Next, we move on to the next important Greek, which is Vega. When we talked about the Black-Scholes model, we made a assumption, one of the assumptions or one of the basic premise that went into the derivation of the Black-Scholes model is the volatility is constant. But in reality, the volatility keeps changing over time. So which means the value of a derivative is also liable to change. So there are two important components in the change of the value of the derivative. One, because of the underlying asset changes with time, and the underlying volatility changes with time. And how much the volatility is changing and how much of a change in the volatility is impacting the value of my call option or the option portfolio is what we are calling as the vega of that particular asset or a portfolio of assets. So the change in the value with respect to the change in the underlying volatility. So if vega is very high, either positive or negative, again for the long position, the vega is always positive, whether it is a call or a put, but for a short position, the vega is negative. So if the vega is very high, it means it's very sensitive to the volatility. Even if the volatility changes a little bit, the price of the asset is going to change, where the price of the portfolio or price of the option is going to change quite drastically. But if the vega is very, very minimal, close to 0, then even if the volatility is changing, the option value is not impacted that heavily because of that. Now, again, just like a gamma, for an underlying asset, the vega is 0. For the underlying asset, because delta is 1, we said gamma is 0. And even the vega is 0 for the underlying asset. So we can't build a vega neutral portfolio with the underlying asset. Again, I have to build a vega neutral portfolio using options itself. So I have to use one kind of an option for making it gamma neutral, another option for making it vega neutral, because both may not be achieved by one single option. It's very rare to get both of them achieved by one single option itself, which means I require at least a minimum of two different traded options, one to make the portfolio gamma neutral, the other one to make the portfolio vega neutral. I may depend on more of them, but at least two of them are very much required, and both of them will introduce additional deltas. So overall, if I have to make the final portfolio delta neutral, then I have to take the position in the underlying asset accordingly. Let's look at one simple example. Consider a portfolio that is, or probably we'll look at it here itself. Now that we have started this example, let me find the vega. What is the vega of this? S naught square root of t n dash d1. Right? So S naught square root of t n dash d1. So this is the vega. Now these are the numbers. Gamma is this much, vega is this much, delta is this much. Now this is the portfolio. I have to make him neutral. Right? Probably here I can, okay, now that let's say I have a few other options that are available for me. So let's say this is my portfolio, and let me assume I have a 50 call. Right? Let me copy existing. So for the existing, the delta, theta, gamma, vega. Let's say this is my portfolio. So I'll say this is the portfolio for which these are the numbers. Then I'm using a strike price 50, strike 50 option with everything else remaining the same. So I'm taking these numbers for one which I am using it to hedge this risk. This is my underlying position. So I want to hedge it using one option which is having a strike of 50 and another option which is having, let's say, a strike of 30. So for that, the delta, gamma, vega are something like this. Now, what is that I have to see? Okay, the delta, the gamma of my position is something like this. Now, let's say I have taken, now let me take a fresh sheet. Let's say I have taken some X number of, let's say I have taken some X number of strike 50 and some Y number of strike 30 option. Now, along with this, I take the position in those. The overall should be equal to 0. So which means 0.077 plus X times 0.023 plus Y times 0.003. This is the gamma, should be become 0. Same way I look at the vega. 7.783 plus X times 2.353 plus Y times 0.330. This should be equal to 0. Now I know what should be my X and Y. Right? So this is what I can talk of. We'll look at a matrix kind of a calculation for this. So I'll say X times 0.023 and Y times 0.003. Similarly, I'll take the vega 2.35 I'll take the Vega 0.33. So this should be equal to minus 0.007, and similarly here it should be equal to minus 0.7. So I'm multiplying x and y. So x and y for me is A inverse times B. So I'll take the A inverse times B. So that is where I'm looking at. So I'll do an M multiplication. I first require A inverse. First let me compute A inverse here. So when I'm doing the A inverse, I'll take the matrix inverse of these numbers. These are the four. Okay. Matrix inverse Okay, here it is coming out to be very small. So probably let me try out with another option. Instead of this option, let me try out with an option which is having a 30% volatility. So just for the sake of it, I'm taking the numbers slightly different. Okay. So once I have taken the numbers slightly different, because I have taken with the same sigma and everything being the same, so we are getting slightly as a problem. And so I'm taking two different options with two different kinds of characteristics altogether. So in that case, this happened to be my matrix, this happened to be my inverse, and based on this A inverse, I am trying to find out A inverse times B. So I am doing a multiplication A inverse times B, which is giving me that I take a position in such a way that minus 3.3 of strike 50 if I am taking, I can make it gamma neutral as well as Vega neutral. Right, if I am taking minus, or probably one more which I want to use here is a 60 strike instead of strike 50, a 60 strike with a variance of 20. So if I change these, so this is a strike 60 and this is a strike 31. Now it is saying that I have to go with a 542 short of a 60 and 5.6 short position of the strike 30 kind of an option. And based on this, now if I go like that, what is happening to my delta now? If I am going it in that way, the delta of the portfolio, this into this, so this became minus 0.03, and this number times this, the delta has become minus 5.5. So overall the portfolio delta now is this plus this, which is resulting in minus 4.96. Now I have to make my portfolio having a delta of plus 4.96. So which means I will go long on 5 shares of the underlying to make the portfolio delta neutral. So this is the kind of a procedure that I am going to follow to make my overall portfolio delta neutral, gamma neutral as well as Vega neutral. So Vega of a long position in a European or American option is always positive, short position is negative. And we should not calculate the Vega from the Black-Scholes, because the Black-Scholes has really made an assumption that the volatility is constant. And one more important thing, as the stock price is changing, right? Let's say if the stock price, if I'm looking at the money, the Vega is 11. Make it in the money, or make it out of money, Vega has come down. Make it in the money, the Vega has come down. So both for in the money as well as out of money, the Vega will be down. At the money, the Vega is going to be much higher. The next important Greek that we are going to look at is rho, which talks about the rate of change of the value of the portfolio with respect to the interest rate. Now, if the interest rate change, what is happening to the value of the portfolio? So it's the sensitivity to the interest rate that we are talking of. So the rho for a call option, we are simply doing the derivative with respect to R. That's the reason we get it as KT e power minus RT ND2. So Vega for a put also will be the same. If I am getting into a rho, it is nothing but KT e power minus RT ND2. So KT e power minus RT times ND2. So the rho for the call option is going to be this much. And when we are doing it for a put, we are talking of minus of KT e power minus RT times N of minus D2. N of minus D2 is 1 minus ND2. So probably if you are simplifying it, minus KT e power minus RT 1 minus ND2. So it's as good as minus KT e power minus RT plus KT e power minus RT ND2, which is nothing but this part is the rho of the call. Rho of the call option minus KT e power minus RT is the rho of the put. So rho of the call minus KT e power minus RT is the rho of the put, which is coming out to be negative here. So we have used a numerical to finally compute both all these 5 Greeks, which are very heavily in use. Now getting into the realities. If I talk in terms of an ideal world, I would really wish the trader will be in a position to rebalance the portfolio delta, gamma, vega, neutral. All the Greeks generally being made to zero. That's the ideality I am talking of. But in reality, only when there is a large portfolio, I can make it delta 0 at least once in a day. Delta 0 is still possible because I can take the position in the underlying asset. Whereas to make it gamma 0 and vega 0, I can't directly use only the underlying asset. I may have to choose 2 other option positions, and I don't know how much of volume typically is present for those kind of traded derivatives. For those kind of 2 different options, how much volume is existing, and that too at a competitive price. So getting for a large portfolio, delta 0 is still possible to execute, but getting a gamma 0 or a vega 0 brings up practical problems in terms of the availability, liquidity of that option positions in that market for a competitive price. For a smaller number of options, yes, I can try out delta neutrality comfortably, but the transaction costs are going to be much higher. So daily maintaining a delta 0 position could be quite difficult, as it would shoot up my transaction costs heavily. So from a reality perspective, we have to be very much realistic in terms of balancing the frequency of rebalancing the portfolio to make them delta and gamma neutrals. And one more important thing which is generally performed is the scenario analysis. Create different possible scenarios instead of just looking at only S changing, R changing, sigma changing. Create a scenario of all of them changing together. The realistic scenario when each one is changing by some amount. Under different kinds of scenarios, we are looking at what is the gain or loss in the overall portfolio for different kinds of time periods, and different kinds of scenarios could be either manually chosen or they could be generated by the model as such. But before we do anything further, it's better that with the model that we have created, we create different plausible scenarios and use all those plausible scenarios to evaluate to what extent there could be a gain or loss in the overall position. And now, if I have to bring in the situation where the dividend yield is present, because if I understand this situation, a lot of other things also could be looked at. I can look at where the scenario of currency option, where Q is more or less equal to the foreign risk-free rate, or we could look at index-based options. So there are a lot of things that could very well be compared once I understand the formulas for Q. And if you look at the difference, in case of delta, we have added e power minus qt. We are multiplying it with a factor of e power minus qt. The same thing is going with respect to gamma. We are multiplying the non dividend version with e power minus qt, both for the call as well as the put for computations of delta and gamma. Similarly, in the theta also, wherever S naught was present, we are replacing that S naught with S naught into e power minus qt. That's the simple way to understand. Wherever S naught came up, we are representing it with S naught into e power minus qt. So the same logic I can apply even for currency as well, because instead of R, I could look at instead of Q, I can replace that Q with RF, which is the foreign risk-free rate. A few other important points. Delta, if I am looking at delta for a forward contract, it's always 1. And if that asset is providing a dividend yield of Q, then we say that the delta of the forward is e power minus qt. Whereas for a future, we talk about the delta being e power RT, because there is a daily settlement that is happening. So I am not waiting for the change in the value of the asset until the expiry date. So that's the reason the delta of the futures contract gets increased by e to the power of RT. And the daily settlement is the main reason because of which the deltas are differing between the forwards and the futures. And I want to bring this concept of portfolio insurance. Look at from the perspective of a portfolio manager. He is holding a very large portfolio. Now, what is his risk? The value of the portfolio going down is his major risk. So he wants to protect his portfolio from the price value going down. So he could have taken a put option to do the protection of his portfolio. So the moment he has taken a put option, even if the value of the portfolio goes down, the put option will enable him to sell the portfolio at a predetermined higher price. So in a way, the value of his portfolio is protected. Now, the problem here is availability of the corresponding put options in the market. Now, this is where we are talking of, instead of going and looking at the liquidity and the availability of the call options in that market, we are talking of creating those kind of options synthetically in such a way that the delta of the position is always equal to the delta of the option which we require to make it synthetic, and reverse of the hedging process, because I want to create that number, whereas in hedging I am taking an offsetting position. So why we are creating a synthetic put here? One, the market may not be there. that much of liquidity may not be there. The exact product on which I have to take the option may or may not be available. Large funds, they may require large volumes, and probably to cater that volume, the exchange may not be having the sufficient number of options. And fund managers often require the strike prices and exercise dates, which are very much different from what are available on the exchange. So because of all these reasons, we see that the large funds prefer creation of a put on a synthetic basis rather than directly trying to buy that put option from the market. So how do I really create a synthetic put option? There are two ways. One, either I can create using the underlying or I can use the index futures. So at any time, the intention is, this is the delta of the put. Let's say if I am having shares worth of 100, I'll find out what is the delta of this. That much worth of the share in the original portfolio has to be sold, and the proceeds should be invested in the risk-free assets. So as the value of the original portfolio is declining, the delta of the put is becoming more and more negative, which means again the proportion of the portfolio sold is increasing. Again, once the original portfolio is increasing, the delta is becoming less negative. So again, it must be decreasing. So which means I can very well alter the position on a regular basis depending on how the value of the original portfolio is either increasing or decreasing. The funds are divided between the stock portfolio, on which insurance is required, versus the riskless assets. But there is a cost because of buying and selling, because at the point what you are seeing is you are trying to buy after a rise in the market, means I am trying to buy at higher price, selling after a decline in the market, so I may not get the right price. So this is one reason. Using the underlying, though I can create a synthetic put position, I may not be advised to do that because there is a heavy cost that is involved in the process. But the same process I can repeat using the futures, where the transaction costs are slightly lesser, much lesser. So that's where we say, instead of doing the same process using the underlying, we can execute the similar kind using the index futures, wherein I will go for this much of the futures contract shorted as a proportion of value is this much, right? So so what we are trying to say here is, instead of directly buying a put option to protect your portfolio, I can create a synthetic put option looking at a proportion of assets as well as the risk-free asset, more or less in line with the portfolio's put. The put of the portfolio, taking the position in line with the put of the portfolio. So this is what I wanted to talk about as a part of the Greeks. We have basically talked about what are the different kinds of Greeks, differentiated between a naked position and a covered position, understood what a stop loss strategy is, what are the limitations of that, then looked at the process of delta hedging, then understood a few more Greeks like theta, gamma, vega, rho, found the relationship between delta, theta, gamma using the Ito's lemma. And then once we have understood all the Greeks, we have got into the realities of hedging, performed a scenario analysis. And in case we are talking about the stocks with underlying dividends, or probably the currency kind of options, how do I adjust the existing formulas for the Greeks to suit to the requirements of these kind of securities? And finally, we talked about what a portfolio insurance is, how can I really synthetically create a put option without actually buying it, right? So that's what is the intention to cover as a part of this particular session. All right.